Okay, on to note 4, and it just says goodwill has been reviewed for impairment and there's no impairment needed. Super. On the 1st of April 2015 then, 2 years ago, we acquired 50 million listed bonds at their nominal value, and they may sell them or they may hold them to maturity, so therefore they're not like normal loans. So based on this business model, they've designated them as fair value through OCI. Okay, so we've got a fair value through OCI loan, all right, receivable loan. So the 1st of April 15, opening 50, interest 6%, that's 3. Presumably we received 3. And then what would you do if it was normal amortised cost? Your closing would be 50, but it's not. We want the fair value because we're treating it as fair value through OCI. So I'm hoping he tells me what that is. So where am I? Yep, the effective rate of interest is 6%. The bonds had a fair value of 42 million at the 31st of March and were correctly treated as of that year. So he's basically telling me I didn't need to do this because he said we've correctly treated it, and it's correctly treated it then. They must have showed a loss of 8 last year. Now we're getting on to this year though, and we know what our opening balance is. The interest stays at 3. You base it on the 50 still. Received presumably 3, and I just want to know what the closing balance is. So, what's he tell me? In my year, we received the 3, good, which was in interest, and then sold the bonds on the same day for 35, which is at the end of the year. So we've sold them. The disposal proceeds were substantially below the fair value. Why would I sell them below fair value? Am I an idiot? Okay, and the fair value was 38. So he's told me what the fair value was, 38. And that's what he says we should do. We should put it in at 38. Now, if I put it in at 38, that means a loss of 4. But they say that it's been sold. They say actually it was sold for 35 at below fair value. A 7 million loss on disposal was charged against profits. Diamond has an option to buy them back, here we go, for 36. So we didn't really sell them because we can buy them back for 36. So that 35, we could buy them back for 36. So will we buy them back if the fair value is 38? Yeah, probably. The fair value is expected to increase in the future, so they'll probably exercise the option. So that 35 that we're going to buy back for 36 is basically a loan, isn't it? So that 35 gets treated as a loan. So let's do some double entry. I want to put in a fair value through OCI, and I want to put it in at 38. Okay, and I want to put in a loan. It's only a 1 year loan, I think, of 35. I think I'll have to check that in a minute. But okay, and I want to also debit my other reserves with that 4, don't I? And that will leave me with a 7, and that 7 should ring a bell because if you remember, they said that they'd shown a 7 million loss on disposal, but we haven't disposed of it, so they shouldn't show a loss on disposal. So we have to put that loss back. Credit the income statement, credit retained earnings. Okay, so let's go do all that stuff then. Positive 7 retained earnings and a negative 4 to other. So there you go, a negative 4 here. That makes that 126. Positive 7 to retained earnings. And what else have we got? We've got to put in the loan, haven't we? The 35 loan to current liabilities. I'm saying that's a loan. So plus 35 there. And then we've also got, is that it? I think. The loan, it's the receivable loan itself. We're putting in at 38, aren't we? Okay, so that's how you would deal with that.